Warren Buffett turned $114.75 into $90 billion.
Wow.
That's not a typo.
That is quite a feat.
But here's the thing.
Okay.
Most people,
Yeah.
even like seasoned investors, totally misunderstand how he actually did it.
It's true.
Right?
There are so many myths and oversimplifications around Warren Buffett's investing style.
Like just buy and hold forever. Or he only invests in companies that are undervalued. I mean,
Yeah.
those sound more like
Yeah, they do.
catchy headlines
Totally.
than like actual workable strategies.
Exactly.
And that's why on this episode of Smart Money Discussions, we're doing a comprehensive analysis of Warren Buffett's real strategies,
That's right.
the actual principles behind his success.
It's incredible.
Excited to get into this.
Yeah.
It feels like everyone throws around Buffett's name,
Right.
but very few people can actually break down what he does.
Exactly.
Can we, maybe before we even get into specifics,
Sure.
clear up some of these common misconceptions people have about his methods?
Yeah. You already mentioned a couple of the big ones.
Okay.
The buy and hold forever myth.
Right.
And the idea that he only buys undervalued stocks.
Right.
Another common one is that he's got some kind of crystal ball. That he can predict the future of the economy.
Right.
But in reality, his approach is far more nuanced
Okay.
and, to be honest, much more interesting.
So let's ditch the myths
Yeah.
and dive into the actual principles.
Let's do it.
What's the first one that really defines Buffett's approach?
The first, and arguably the most important,
Okay.
is the idea of a circle of competence.
Okay.
Buffett only invests in what he understands.
Okay, I get that in theory.
Yeah.
But, like, doesn't that seem kind of limiting?
Mm.
Wouldn't you want to have as many options as possible when it comes to investing?
It might seem limiting at first,
Okay.
but think of it this way.
Okay.
By focusing on your strengths,
Okay.
on the industries and businesses you genuinely understand, you significantly reduce your risk.
Okay.
When you spread yourself too thin, trying to be an expert in everything,
Right.
you actually make it harder to make clear,
Yeah.
informed decisions.
So it's almost like a quality over quantity thing
Precisely.
when it comes to investing knowledge.
A great example of this
Okay.
is Buffett's investment in See's Candies.
See's Candies. Okay.
Now, he's not a confectionery expert,
Okay.
right?
Okay.
But he understood the power of consumer behavior and brand loyalty.
Okay.
It wasn't about the candy itself,
Right.
but the strength and longevity of the business model.
That makes a lot of sense.
Yeah.
It's not just about liking a product.
Right.
It's about understanding the business behind it.
Understanding the underlying business is key.
Okay, so principle number one,
Yeah.
circle of competence.
Circle of competence.
Find what you know and stick to it.
Yes.
Got it. What's next?
The next principle is the idea of a margin of safety.
Margin of safety. That sounds intense.
It might sound intimidating, but it's actually a very practical concept.
Okay.
It means don't just buy stock in a good company.
Okay.
Buy it at a price that minimizes your potential for loss.
Okay. That makes sense in theory,
Yeah.
but how do you actually calculate a margin of safety?
Right.
That feels a little fuzzy to me.
It's less complicated than it might seem.
Okay.
Essentially, you need to determine what's called the intrinsic value of a company.
Intrinsic value.
You got it.
All right.
Think of this as trying to figure out what a company is truly worth based on its earnings and future potential.
Yeah.
Then you aim to buy the stock at a significant discount to that intrinsic value.
So it's kind of like buying something on sale, but for stocks.
That's a great analogy.
You're looking for that hidden gem
Yeah.
that's worth way more than the sticker price.
You're not just buying something valuable.
Right.
You're buying it at a price that gives you a cushion.
Okay.
Just in case your initial assessment was a little off,
Okay.
that cushion is your margin of safety.
I'm starting to see how these principles work together.
They absolutely do.
Yeah.
And that brings us to one of Buffett's most famous analogies,
Okay.
the idea of Mr. Market.
Mr. Market.
Mr. Market.
Okay, now I'm really intrigued.
Imagine that Mr. Market is a person,
Okay.
and every single day he shows up at your door offering you prices for stocks in your portfolio.
Okay, so far so good.
All right,
Though it does seem a little strange to picture the market as a dude knocking on my door.
stick with me.
Okay.
Now imagine that Mr. Market is also incredibly emotional.
Okay.
Some days he's euphoric, super optimistic, and he'll offer you ridiculously high prices for your stocks.
Gotcha.
Other days, he's pessimistic, and he'll offer you prices way below what your stocks are actually worth.
So the market is basically a guy with extreme mood swings.
Exactly.
Okay.
But here's the key.
Okay.
You don't have to buy or sell just because Mr. Market is feeling manic or depressed.
Wait, so I get to choose?
You do.
When I interact with this moody market guy.
That's right.
I don't have to let his emotions dictate my decisions.
You got it.
Interesting.
You get to decide when to engage.
Okay.
When the price is right for you,
Right.
you can be patient. Wait for those opportunities when Mr. Market is being irrational and offers you a great company at a bargain price.
Yeah.
That's where your margin of safety comes in.
This is blowing my mind a little bit.
That's a powerful concept.
It totally changes how I think about market fluctuations.
Yeah.
It's not about getting swept up in the panic or the excitement.
No.
It's about using those swings to my advantage.
You're getting it.
Okay, cool.
And that leads us perfectly into how these principles play out in the real world
Okay.
with some of Buffett's most successful investments.
Let's get into it. I'm ready to see how all these pieces fit together.
All right, let's do it. So let's start with one of Buffett's most famous and successful investments,
Okay.
Coca-Cola.
Okay. Coca-Cola. I mean, everybody knows Coke.
Right.
But how does this seemingly simple investment actually fit into these principles we've been discussing?
Well, first off, it's a business. Buffett understands.
Right.
Strong brand, global reach.
Yeah.
He was already deeply familiar with the consumer market.
Right.
And perhaps even more importantly, he saw that Coca-Cola was undervalued at the time he bought it,
Okay.
back in the late 1980s.
So he was operating within his circle of competence,
Precisely.
and he found his margin of safety.
Exactly. And then, true to form, he did what he does best.
Okay.
He held it for decades.
Wow.
And the returns on that investment have been truly incredible.
Okay.
That's the power of long-term thinking in action.
That makes sense. It's a classic example.
Yeah.
For sure. But what about something a little more
Yeah.
niche? What about Geico? That one always stood out to me.
Geico, another excellent illustration of Buffett's principles.
Okay.
See, insurance is a business he knows well.
Right.
And Geico in particular had a very specific competitive advantage that he recognized.
Okay.
Low costs.
So see, even within his circle of competence.
Yeah.
He was looking for those businesses that had a unique edge.
Absolutely.
Oh, yeah.
That's how companies maintain profitability over the long term.
Right.
And that consistent profitability is ultimately what allows you, the investor, to benefit
Yeah.
from that long-term growth.
That makes sense. But here's where I get a little tripped up.
Okay.
What about his investment in Apple?
Yeah.
That seems to go against his whole only invest in what you understand rule.
Okay.
I mean, Buffett wasn't exactly known as a tech guy for most of his career.
That's a very sharp observation.
Okay.
And it shows that even someone as successful as Buffett is willing to adapt. He realized that Apple, while technically a tech company,
Yeah.
also possessed some really enduring qualities.
Okay, like what?
Brand loyalty,
Yeah.
a powerful ecosystem,
Yeah.
and a product that people genuinely felt they couldn't live without.
Okay.
He recognized that those were incredibly strong business advantages,
Yeah.
even in a rapidly changing industry like tech.
Interesting. So he kind of expanded his circle of competence
Exa-
to include a company that clearly demonstrated those core principles he looks for.
Exactly. It wasn't about chasing the latest trends in tech.
Right.
It was about recognizing the underlying business strengths
Gotcha.
that have the potential to endure.
Okay, this is all starting to click for me, but let's get down to brass tacks here.
Right.
How can I actually use these principles in today's market?
Right.
I mean, I'm no Warren Buffett.
That's the beauty of it.
Okay.
These principles are applicable to anyone, regardless of their level of experience.
Okay, cool.
The first step is to define your circle of competence.
Okay.
What industries or businesses do you personally understand really well?
Okay. I can start brainstorming that right away.
Good.
What's the next step?
Once you've got a handle on your areas of expertise, the next step is to develop a system
Right.
for actually valuing companies.
Right.
There are tons of resources available, books, websites, even online courses that can teach you the basics.
So do your research learn how to assess a business?
Yeah.
Then what?
Then comes the hardest part for many new investors.
Why?
Be patient.
Be patient.
Don't get caught up in chasing fads
Right.
or try to time the market.
Okay.
Instead, focus on building a portfolio of solid, high-quality companies
All right.
that you believe in for the long haul.
Okay. I see. So it's more about finding those steady, reliable businesses
That's a great way to put it.
than getting lucky with the next hot stock.
And it's important to remember that even someone like Warren Buffett makes mistakes.
Really?
Investing is a journey of continuous learning and adaptation. No one gets it right all the time.
That's actually kind of reassuring to hear.
Yeah.
It makes it seem more attainable.
It is attainable.
So we've debunked some common myths, we've gone deep on these core principles,
Right.
and we've seen how they work in practice.
Exactly.
What's the one key takeaway you want our listeners to walk away with from this comprehensive analysis?
If I could leave our listeners of Smart Money Discussions with one thing, it would be this. Focus on implementing just one of these principles this week.
I like that. Don't get overwhelmed.
Right.
Just pick one thing and really master it.
Exactly. Maybe it's clearly defining your circle of competence.
Okay.
Maybe it's learning a basic valuation method, like the discounted cash flow model.
Hold on. Can we rewind for a second?
Sure.
You mentioned discounted cash flow,
Yeah.
and I think that might be a new concept for some of our listeners.
Okay.
Can you break that down for us?
Absolutely. The discounted cash flow model, or DCF, is all about figuring out how much a company's future earnings are worth today.
Okay.
It's based on the idea that money today is worth more than money in the future
Right.
because you can invest it and earn a return.
Right.
So you're basically trying to estimate the present value of a company's future cash flow.
Okay, that makes sense.
Yeah.
So instead of just looking at a company's current earnings,
Yeah.
I'm looking at their potential future earnings
Yeah.
and then adjusting that number based on how much that future money would be worth to me right now.
You got it.
Okay.
And while it might sound complex,
Yeah.
there are a lot of great resources out there that can help you calculate DCF.
Cool.
You don't need to be a math whiz to do it.
That's really helpful.
Yeah.
Okay, so back to your point about taking action.
Yes.
Pick one principle, like defining your circle of competence.
Right.
Or learning about DCF.
Yeah.
And really focus on implementing it.
Exactly. The key is to take action and start putting these principles into practice.
Love it. Small steps, consistent progress.
That's it.
And who knows, maybe one day we'll all be as successful as Warren Buffett. Okay, maybe not billionaire successful, but
Hey, you never know.
that's true.
But the real success is in achieving your own financial goals.
Right.
Whatever those may be.
So true. And that's what Smart Money Discussions is all about.
Absolutely.
Giving you the tools and knowledge to make smart financial decisions
Yes.
that help you reach those goals.
Couldn't have said it better myself.
Awesome. Well, hey, if you want more insights and actionable advice, make sure you subscribe to Smart Money Discussions.
Please do.
We'll be back next week with another detailed discussion
That's right.
of a topic that's crucial for your financial success.
We'll see you then.
Until then, happy investing, everyone.